Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, 9 a.m. Eastern every Monday morning, this week on Tuesday for the holiday, but with the stocks to watch and the market news you need to see. Nation, as so often happens, the best returns are found in tying a piece of news or information into a related theme that the market has yet to understand. And I've found just that with recent news of insurer Aflac's $100 million investment and continuous funding into a private credit company. And it has everything to do with some of the most popular dividend stocks on the channel. I'll highlight the upside in today's main topic along with stocks I'm watching this week with some big news for AI stocks and a special update for shares of Medical Properties Trust, MPW, that could signal the worst for the stock problems are behind it. But first, if you ever want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description. These are the stocks I'm following in major multi-year themes, with one of the picks up more than 100% and the group an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and they'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link in the description. Back to our main topic though, we've been covering business development corporations, BDCs, a lot lately, and it's not just because these monthly dividend stocks offer some of the highest yields among dividend payers. It's not just because they are some of the most popular dividend stocks and carry an intrinsic efficiency in taxes. It's also because lately these special corporate structures are getting a lot of attention from big money investors and could be about to add price returns on top of those high dividend yields. In fact, an ETF of these stocks is already up 7.5% this year. Now that is 3.8% behind the return on the S&P 500, but including that 9.3% dividend yield, and the group is blowing the doors off the stock market. Now, business development corporations, those BDCs, are a special type of corporate structure. BDCs make loans to small and mid-sized businesses, the kind of companies that need more money than a regional bank can provide, but not enough to list on a stock exchange. These BDCs enjoy a special tax break if they pass on almost all of their income from those loans. They pay no federal income taxes on that. And these BDCs have long been on our radar for those monthly dividends, but news in the Wall Street Journal caught my attention and could mean increased funding for these companies. Earlier this month, insurer Aflac announced it had paid $100 million for a 40% stake in Treeline Capital Partners, a private credit company lending to small and mid-sized businesses. Now, Treeline may be set up as a partnership, but its business model is very much similar to what we see in those BDC stocks. As part of the deal, Aflac is also agreeing to a multi-year commitment to help fund loans with its investable cash. You see, insurance companies have that constant cash flow from the premiums you pay each month, but need to invest that cash to pay policies and produce a profit. It seems the double-digit yields from BDCs are getting attractive, and it solves one of the biggest problems for these dividend payers. Now, of course, that special tax exemption is great. It allows dividend investors to escape the double taxation you get with most stocks, where the company first pays taxes on its own earnings, and then you get slapped with taxes on the dividends. With BDC structures, the company pays no taxes, so those profits go straight to your account. The problem here, though, with having to pay out nearly all their profits, BDCs constantly need to raise funds to make new loans. For example, in the first quarter presentation by Main Street Capital, the company lists 4 notes payable, SBIC debentures, and credit facilities totaling over $2 billion. And when interest rates are too high like this, BDCs also raise funds through a share sale, diluting current shareholders. So this new attention by big money insurers and the potential source for funding means BDCs could have a clear runway for growth over the next few years, and it's already starting to show in the stock prices. That ETF, the Putnam BDC Income Fund, ticker PBDC, pays a 9.3% dividend and holds shares of 18 of these companies, high-yield stocks like Ares Capital and one of my favorites, Main Street Capital here. The ETF has seen the price jump 21% in the last year on top of that dividend. Now that 6.8% management expense fee is a freaking Greek tragedy, so instead, I'd look to individual names in this group. And first on our list, Main Street Capital, ticker MAIN, with one of the lowest yields at 8.4%, but one of the best for dividend safety and price return. The dividend hasn't been cut in the last 5 years, and while it hasn't grown much either, there have been enough special dividends to grow that cash flow, and the total return of 74% is an 11.7% annual return. So dividend yield plus price return on this one. The company had 182 portfolio investments as of the first quarter, with the largest representing just 3% of total fair value. So a hit to any of these investments isn't going to hurt the shares that much. That 8.4% dividend yield is dwarfed by the 12.8% yield on the company's portfolio of loans, a 152% dividend coverage ratio, and should mean we continue to see that dividend growth and price return here. Horizon Technology Finance, ticker HRZN, is another I've been following for a while because of its model is very close to the venture capital industry in which I used to work. Horizon makes secured loans to venture and private equity-backed companies in the life sciences and technology industries, a $26 billion addressable market. It's a market that's taken a hit over the last couple of years with the venture capital crash, but as a former VC analyst, folks, I can tell you there is no better market for growth than technology, life sciences, and healthcare for these business development corporations. The portfolio of loans is well diversified by sector, geography, and company stage. Now, you would expect most of the portfolio to be in that Silicon Valley West Coast area, here with 41%, but it also has nearly 2/3 in the company elsewhere in the Midwest and East Coast. The portfolio is diversified across company stage and sector. Now, all these are going to be those fast-growing startups backed by venture capital, and again, a great niche in healthcare and technology. That 11.4% dividend is very well covered with an average portfolio yield of 15.6%. So I think we have better dividend growth and price returns soon once that venture capital market recovers a little. Now, researching for this video, I found a great resource if you're following these high-yield monthly payers. Raymond James puts out a weekly BDC report where you're going to find returns, valuation, dividend yields, and other information for comparison. And I know most investors are just going to jump to this table of total dividend yields, with yields ranging from 5.9% all the way up to 18.5%, dividend growth as high as 18% over the last year. But more important here is to compare those yields against their weighted average yields on each company's portfolio of loans. Remember, this is a key measure of dividend sustainability for these BDCs, that they're collecting a higher average rate on their loans than they pay out for dividends. For example, as we saw with Horizon Technology Finance, it collects an average 15.6% on its portfolio loans, well above the 11.4% dividend yield, and means dividend growth and share price returns could be soon to follow. The information is available in tables and charts, though it's all printed extremely small. Along with comparing the portfolio yield and dividend for each, check out this base dividend coverage chart also to see which BDCs has the most excess income over that committed payout, which might be able to grow their dividend faster. At the top here, we see Scion Investment, CION, with its 9.1% yield and 176% dividend coverage, followed by Main Street with its 8.4% yield and 154% coverage rate. Shares of Prospect Capital, ticker PSEC, have struggled over the last year, but have bounced back recently on top of those higher dividend yields. The company manages a $5.7 billion portfolio of 122 investments in companies across 36 industries and earns a 12.1% yield on its portfolio. Now that's below the 13.8% dividend yield, so not the safety I like to see, but the base dividend, so exclusive of any special dividends, is well covered. The company has been able to pay out nearly $21 a share in dividends, more than $4.2 billion since the IPO. And here, Stellus Capital Investment, ticker SCM, pays out an 11.3% dividend yield, covered by its 11.9% average yield on its portfolio of loans. Stellus has nearly 97% of its loans in first lien or senior secured debt status, which means it gets paid first even if a company defaults. Almost all the portfolio, 98%, is also in floating rate loans, so all in all, this is one of the safer BDC strategies you're going to find. Stellus has grown the dividend by 17% over the last 5 years, while producing a 68% total return over the period. On to the stocks I'm watching this week with big news coming from AI stocks and MPW. First, C3.ai, ticker AI, is down 48% from last June's jump in AI-related stocks, along with many of the other AI software companies. Now, I continue to add shares of software and services stocks here in this group as that next wave in the theme. After all the semiconductor hardware stocks like NVIDIA create that infrastructure for artificial intelligence, that's going to lead to these use cases for these software and services stocks. C3 will have a chance to prove that outlook when it reports earnings Wednesday, with analysts expecting 16% growth in revenue, though the earnings loss is expected to expand to 30 cents a share from just 13 cents a share last year. While I think C3 will eventually do well, I prefer some other stocks in the theme here like Palantir, Snowflake, and Unity Software. UiPath, ticker PATH, is doing relatively better and has seen its shares continue to rally from last year. The robotics automation software provider is expected to report only slight earnings growth to 12 cents a share when it does release its earnings here on Wednesday, but is forecast to post 19% revenue growth this year and next. The company has a history of beating its expectations, though that outlook is what matters here, and there is a fear that industrial robotics users may moderate their orders in this economic weakness. Now that said, I would be buying on any dips here as the company has a long runway for sales in this growing market. Zscaler, ticker ZS, is down 32% since February, along with a sell-off in the broader cybersecurity theme after a strong 2023 rally. Now, the company is one of the last reports in the theme, with expectations for Thursday's release to show earnings jumped 35% from last year to 65 cents a share. Now, Palo Alto Networks did shake investors' faith in the industry with its disappointing outlook, noting that enterprise customers were getting a little budget conscious on those cybersecurity spending. Zscaler is likely to echo this warning, but I'm taking the opportunity to pick up shares of my three favorites in this space: Zscaler, ZS, CrowdStrike, CRWD, and Palo Alto Networks, PANW, as cybersecurity continues to be one of my favorite growth trends over the next decade. Despite any warnings we hear here from management, ZS is expected to post 25% plus revenue growth this year and next, along with 35% annualized earnings growth over the next 2 years. Medical Properties Trust, ticker MPW, last week further proved the worst of the company's troubles are behind it, closing an $800 million loan on a portfolio of its UK hospitals. The fact that this loan was closed at a surprisingly low 6.9% rate helps to show the company has that access to capital that it needs to survive this years-long weakness in hospital operations. MPW has now closed $2.4 billion in liquidity to pay down its debt, well over the full-year target of $2 billion. And the coming auction of Steward properties in June could help further boost investor sentiment as that real estate owner gets new tenants that can now pay the rent. Showing you that bigger picture idea here with the SectorSpider.com sector tracker. Despite the record high on the NASDAQ and overall positive investor sentiment, only 2 of the 11 stock sectors closed higher last week, with heavy losses of more than 1% in 7 of the groups. Energy stocks got slammed on that 3-month low in oil prices and may have further to fall as the price of crude comes back into that $68 to $75 per barrel range. Real estate stocks got hit across the property types on the Fed minutes last week, convincing investors that higher for longer interest rates would fail to give the sector the relief it needs. Real estate is now the worst performing sector this year, with a loss of 6.7% and has only produced a 1.4% return over the past 5 years. Looking at the longer trends here, folks, it's a tech world. We just live in it. Now, that's become clear with the 39% return on stocks in the technology sector over the last year, and the mind-boggling 193% return over the last 5, more than double the 87% return on the broader stock market. Only 3 of the tech stocks in the S&P 500 are lower over the last 5 years, with Intel down 31%, Cisco Systems down 15%, and VeriSign down 12%, while 36 stocks in the sector, more than half the 65 constituents, have doubled in price. It's easy to write off this sector as overpriced with a price of 28 times its expected earnings, but earnings growth for the sector is expected at 19% this year and next. It's going to help drive those prices further. Investors just should not neglect this sector just because it has run so far so fast. Now, in the stock market news, the Consumer Price Index, so that CPI measure of inflation, cheered the market earlier this month, breaking a multi-year trend to disappointingly high price pressures and renewing hopes for a rate cuts later this year. The minutes for the most recent Fed meeting, though, brought investors back down to earth last week when it showed that several of its members were open to rate hikes if inflation did not continue to moderate. We're going to get confirmation of that, or bad news, with the personal consumption and expenditures, that PCE report of inflation on the Friday this week. It's particularly important here, not only because it's the preferred measure of inflation by the Fed, but also just to confirm or stand in contrary to that moderation we saw in the CPI report. While inflation has been persistently high over the past few months, I do think it will continue to slow as employment and other parts of the economy look to be weakening slightly. Any slowdown in inflation, even if it comes at the expense of a slower economy, is likely to be good news for stocks and keep this bull market going. Get your free report and see my forever stocks with the link in the video description, the stocks I'm buying for the next 30 years, already up an average 94% last year. Or click on the video to the right to see the highest paying monthly dividend stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.